So good morning, everybody, and thank you for joining us for our webinar this morning. My name is Jo Edwards. We help Andrew and his team at WMT with their marketing, hence my arrival at the webinar this morning. So I'm here to introduce Andrew. As you can see, our webinar today is all about what a buyout can do for you. And I'm delighted that Andrew Williamson has been able to join us to deliver this webinar. For those of you familiar with Zoom, you'll recognise the toolbar. For those of you not so familiar, if you would like to ask Andrew any questions throughout the presentation, please use the Q&A option on your toolbar. That way, Andrew can see the questions coming through. We will have a Q&A at the end of the presentation today, so Andrew is going to try and answer as many questions as possible before we finish. And there will be a recording of this webinar made so that we can put that up on the WMT website and make that available as an on-demand version should you choose to re-watch. So at this point, I will hand over to you, Andrew, and I hope everybody enjoys the webinar.
Morning all. Thank you, Jo. Yes, good morning. Real pleasure to be with you, and thank you all for finding the time to join us. So I saw lots of familiar names and faces on the attendee list, and also some new ones. So for those of you who don't know WMT, we're a firm of accountants, tax advisors, and corporate finance advisors. Offices in St Albans and London. So my role, a couple of roles. So I'm managing partner, so I look after various aspects of the business itself. But in terms of the client work I do, that usually fits it within the corporate finance area of the practice. So that's helping people with buyouts or trade sales of companies. So helping people buy or sell, restructure or refinance their companies. So real pleasure today to talk about buyouts themselves. So let me just start by perhaps setting the scene a little bit by explaining what I mean by a buyout. So with a buyout, what we're talking about is the change of control of that business. So it's the sale of a majority stake. Now, forgive me, I'm going to talk about companies in this scenario, but obviously many businesses can be in different legal structures. But the focus I'm going to have today is on buying out a company. And the most common type of buyout, so when there's a change of control, if you like, some succession plan, and the business ownership transfers from let's imagine it's the founder to a new team. The most common buyout is that of a management buyout, or MBO, and that's probably been a very successful form of succession. So you've had just imagine the founders of the business, he or she wish to move it on, and there's usually been a team there that's following them or built around them that's ready to take over the business. Occasionally, you might have some subtleties to that where there might be some management team brought in at the time of that buyout. So you might have some people buying in and buying out. So there are some subtle changes around that. But recently, and the focus I'd like to have today is on something that has changed in the market, which is the introduction, or the more common form of employee buyout. So as well as management buyouts, where you've just got a few individuals, top team, if you like, buying out an organisation, something that's emerged in the marketplace is the rise of the employee buyout. And what I'm going to do is explain a little bit about the subtle differences between an employee buyout and a management buyout, and then step you through how that may work and what that means. So let me start by talking about why has there been this increase in employee ownership, and what's been driving that, and what sort of flavours does that take. So the form of employee ownership gained some interest, I suppose, many years ago, when it was always viewed as an ideal way to incentivize the wider team to take an interest, if you like, become more entrepreneurial in their outlook, to help drive the business forward. Employees having a stake in the ownership of the company was viewed as being a way of aligning goals. So you would have a team of people working with the founders, with the owners of the business, and their goals are aligned to drive things forward. And that's taken several different forms over the years. And the two most common forms of employee ownership that I'd just like to touch upon. One is around the use of share options, and the other is around the actual ownership of the shares. So it's not uncommon at all, and certainly in the last 20 years, the use of share options within SMEs, small, medium-sized businesses, to align goals has become widely accepted, and the government has encouraged this with the use of various schemes. So a share option is the promise, if you like, that the business directors are making to the employees that, subject to certain conditions, they will become shareholders. And that's usually used to try and align goals when a business may be working towards a sale. But a buyout is much more than options. A buyout is the actual transference of the shares. And that's quite a difference, because that's bringing people into the ownership at that point. So it's not a promise about the future, it's the actual transition of the ownership now. And that transference of the shares, this transference of control, when you start to look at employee ownership, then there's different ways in which that can take place. And I guess the two major distinctions that I'd like to draw is whether those shares are held directly by the individuals or whether they're held indirectly on their behalf. So let me start by explaining how those two models differ and why one of those has become the much preferred route. So if with a management buyout, it's obvious that you've got a number of key individuals and they're going to hold the shares personally. If the buyout embraces a much wider team and across all employees, then there are some disadvantages with the individuals holding the shares personally. Not least, employees come and employees go, and then you'd have to have a mechanism by which those shares are then moved or come back into the hands of the right individuals. Whereas most employee buyouts that have taken place, it's the rules, if you like, and I'll come on to those in a second, allow people to hold the shares in a trust that is set up for the benefit of those employees. So the employees can own the business, but instead of holding the shares directly, they're held in trust for their benefit. And the name of that trust, and I'll sort of weave a little story and give the narrative of how we've got there. The name of that trust is an Employee Ownership Trust, or an EOT. So that's been very popular over the last few years, 3 or 4 years. I'll talk you through how the numbers have built up. But that use of an employee ownership trust has really gained momentum. And then what I'll do is actually explain how there can be a combined approach where shares can be held in both the direct and indirect, some hybrid type model. And I'll paint the picture of how we get there. So employee ownership. Why has it become so popular? If you think about the drivers in the business and the success of a particular enterprise, particularly in a service-led economy such as the UK, the success of the business goes hand in hand with, if you like, the productivity and the deliveries from that team. And it's this idea of aligning the goals of the employees and being able to reward them seems to have really caught the imagination of both government and other stakeholders. And it's seen this equitable element of helping ensure that the employees also benefit from driving that business growth. That seems to be proving itself as quite an effective way of driving forward performance. I suppose there are also some other issues that feed into this when you are dealing with the transition, the actual buyout, because there are many ways in which you could incentivize employees and share the rewards of a business. But the actual step to go and actually change control and pass that to the employees is quite different. And I would suggest what we see is there are numerous what I would describe as softer issues at play as well. You often see this point of succession where the business owners feel that they've driven things forward, they've done it with a loyal, hard-working team around them. There's this debt of gratitude, if you like, that people then want to let others have a chance to succeed and drive things forward. There's a bit of ideology around it as well. I suppose it's viewed as a friendly face of capitalism. This really gained momentum, I suppose, following the last economic downturn, 2008, around that time. There was a view that capitalism, and particularly with the way in which the banks had performed, there was something missing. There was a disconnect between the rewards of the owners of capital versus those in the business. And there were some drivers there on the softer side to try and get that balance a little bit more in equilibrium. And at that particular time, I suppose John Lewis, the John Lewis partnership, was held up in high esteem. And John Lewis is probably the most famous employee-owned business in the UK. And John Lewis at that particular time was riding high, and it was felt, is there something around the ownership model that we can learn from and apply elsewhere? Some of the other drivers around creating this legacy, and where the succession plan by transferring ownership to a team of employees, or the employees, and perhaps a key management team, that can ensure that the vision continues and the culture remains intact. But also around that time, in 2014, there was a change in government legislation as well, and there was there was a Nuttall review. I'll come on to this in a second, back in 2014, and that encouraged specific tax rewards or tax incentives to be applied to businesses that transitioned into employee ownership. And there's a particular tax break for both the sellers and the employees if the business goes into employee ownership. So, motivating employees, rewards for employees, driving forward in performance, driving forward engagement. And I suppose for the seller, one of the other benefits is that they can realize value through this buyout process, the transition, but without having to face some of the challenges that would go with selling externally to trade or to private equity, which is not a process to be underestimated. So it's a way in which owners can pass on the legacy, realize some value, and avoid some of the pain and complication that may arise from a trade sale. Let me just show you some facts figures. This is pulled together through 2019 and released just this year. This is a survey from University of Leeds, Professor Andrew Robinson and Professor Andrew Pendleton. The White Rose Employee Ownership Centre did a survey of the about 470 employee-owned businesses that are around the UK. And what that demonstrated is how this is increasing. So there, I've got the stats here that were underlying this survey. Almost of these 470 businesses, 61% of them transitioned into employee ownership in the last few years from that change in legislation from 2014. And actually, that growth is increasing. So over 50% of them since 2017, and there's an increase of 28% in 2019. So it's one of those exponential growths. We've all got used to seeing the curve with the exponential curves recently with COVID cases. And if you were to imagine a curve like that shape with the number of companies that are moving into employee ownership, then it really has rocketed over the last few years. And there's a particular couple of sectors, or one particular sector that has predominated of that change, and that's in the professional, scientific and technical area. So nearly 30% of the companies that have transitioned in the last few years since 2017 have been in the professional, scientific and technical space. And I think the reason for that is because the capital, the goodwill, if you like, rests in the team. Rather than some other businesses where you may have intellectual property or some product that the goodwill is seen as residing in that particular asset. In the professional services and scientific and technical areas is the knowledge and know-how, and therefore that does seem to be a stronger link between the alignment there and of the business and the alignment with the employees. So some stats here. It's over 30% of the respondents were in that sector approximately. And if you extend that out to include some of the property sector, architects, design consultancies, some other management consultancies, real estate, then over 50% of the companies that have transferred since 2017 have been in that space. Geographically, London dominates, as you would expect, with about nearly 21% of the companies that have converted since 2017 being in London. But interestingly, Scotland has got a high proportion of employee ownership as well. So this table demonstrates the top 50 employee-owned businesses in the UK. This was published in 2020, but it's based on some of the results of the companies in 2019. So those top 50 companies have approximately 20 billion pounds of turnover, sales, nearly 180,000 employees, and this is growing on a like-for-like basis. Now, number one on there is still the John Lewis Partnership, but as you can see, there are a couple of new arrivals in there. They're highlighted in the table. And this doesn't include some other household names that have transferred into employee ownership more recently. You may have seen in the press, Richer Sounds, the hi-fi audio-visual retailer, transitioned to employee ownership, as did Aardman Productions, the producers of the Wallace and Gromit films. They've also transitioned recently into employee ownership. So the pace is there, and it is growing, and it's becoming an increasingly important sector within the economy. So let's just explore how somebody might transition a buyout into employee ownership. But I can also, when I go through this, I'll also explain some of the subtle differences between moving into employee ownership and a management buyout. So I'll cover both types of buyout. So just imagine, let me set the scene. An established SME business, been going for many years, two founders, Oliver Timer, old timer, and a very wealthy individual, Ivor Nuff. So both of these two individuals have decided that they would like to transition the business, and they're thinking about how do you move it on. So they're 50-50 shareholders in SME Limited. So the sort of structure that you might see would be where a trust, just imagine Oliver and Ivor want to pass the business on, or at least majority control. So this is a hybrid where you would end up with Oliver and Ivor retaining 10%, but both selling 40% each of their business to a trust. And that trust I've marked here as an EBT, so an employee benefit trust. So that trust exists for the benefit of all the employees. So that trust is a separate, I'm going to say it's a separate entity from Ivor and Oliver. So it is the legal owner. Any lawyers on the call would probably correct me and say it's the individual trustees who are the separate legal entities. But for these purposes, just imagine it is a separate entity. So what's happened at this juncture is Oliver and Ivor have sold some of their business, 80% of the business, to the trust, this employee benefit trust. So what is an EBT, and how does that fit into this whole picture? So this trust would be set up, it's a discretionary trust, and it would be set up to benefit all the employees of SME Limited. And the trustees, the people who control the trust, are separate from the business. So there is this distinction between the trustees and the company itself. Now, it could be that Oliver and Ivor actually sit as trustees too, but when they do so, they'll be sitting in the capacity of a trustee, and they would have the discretion to award the remuneration, the benefits, shares to the employees. Now, this use of an EBT is not new. In fact, this has been going for a while, and often EBTs were used as a way of helping to transition shares. They were a way in which people could buy and sell shares as employees. They almost acted as a warehouse, if you like. And it is this view that it's a separate legal entity that means you are creating this buyout structure. That's what employee benefits for trusts were used for, or that's what they were intended for. But unfortunately, they got a little bit of a bad reputation because they were exploited for some less scrupulous advisors used these employee benefit trusts to create some other ways in which they could get cash from companies, and the government were seeing them as being viewed for tax avoidance reasons. So it was back in 2014, as I mentioned, that the Nuttall report, a lawyer, had reviewed employee ownership post this collapse of the last economy in 2018, and put forward a report to government that encouraging this sort of shared ownership, shared capitalism, would be a way in which the economy could move forward, people would share in the benefits, and it was piggybacking on the success at the time of the John Lewis business. And it was coined by government as trying to create this John Lewis economy, this John Lewis model. And this was put into law back in 2014, and there were various tax incentives that would arise if companies set up this employee ownership using an employee ownership trust, an EOT. Now, an EOT is an employee benefit trust. It's just a particular flavour of EBT that has some tighter rules around it to prevent some of the tax avoidance issues that happened before. So occasionally when people talk about employee ownership and employee buyouts, you may hear people talking about an EOT or an EBT. And I'm so sorry for all this jargon, but for the purposes of this, they're really one and the same. An EOT is an employee benefit trust. It's just got tighter rules around it as to how it operates. And those specific rules then give rise to some tax advantages. And I think this has been one of the key drivers for the momentum that we've seen in the use of trusts to conduct buyouts. The seller, so Oliver and Ivor in my previous example, if they sell to a trust, then there is no tax to pay on the proceeds of that sale. So particularly at the moment when people are concerned about changes to capital gains tax, and in recent times, entrepreneurs relief, many of you will be familiar with that, which was a very generous allowance to enable the sellers of a business to enjoy what was effectively a 10% rate of tax on the proceeds up to 10 million. In the last budget, that was reduced to 1 million, and it's predicted that that may be attacked again. Well, selling to an EOT in this form actually is better than that, and there's no tax to pay. And there's also a tax advantage for the employees. So, oh, excuse me 1 second. Sorry, went the wrong way. Thank you, found the right slide. So if I just compare the difference of selling what may be on a management buyout, where the founders would enjoy entrepreneurs relief, compared to selling to an employee buyout by an EOT structure, this trust structure, there are a couple of key differences. So to enjoy entrepreneurs relief, there are certain rules around the percentage of shares that people have to hold and for how long they have to hold them. That's not the case with the EOT. There are some differences there. There are also some differences around whether the sellers have to be an officer or employee of the company. And again, there are some differences there. And this key difference between whether it's a 10% rate of tax on proceeds up to 1 million or full capital gains tax on proceeds above 1 million versus zero tax, I think has been a key driver for helping owners look at the possibility of an employee buyout compared to just a management buyout. There are, however, some other restrictions. So it's key that control does pass. So it's not just a partial sale, it is a buyout. So more than 50% of the business must end up in the hands of the trust for the benefit of all the employees. And it has to stay like that for a minimum of 12 months following the deal. Otherwise, there can be some tax clawbacks. But there are also some benefits for the employees, and they can enjoy a tax-free bonus. Let's assume the business is bought out and it performs. Then one of the benefits of working in an employee-owned business is that the individuals themselves, the employees, can enjoy a bonus, a tax-free bonus of up to £3,600 per annum. So benefits for the seller, benefits for the employees. So how would you go about doing this and how would you fund that? So it's all very well thinking, okay, this could work, might be interested in this, could see how either a group of employees, the management team, might be interested in buying out the business, or via this trust structure, there might be the ability to sell to all employees. So let me just step you through how that may look in terms of how a deal could be funded. So we've got SME Limited there, and we've got the trust where the EOT is looking to buy the shares, or at least 80% of the shares in the example I gave earlier, from Oliver and Ivor. How would it do that? There are banks now that would look at helping to fund this. So I was speaking just to Virgin and Clydesdale earlier this week on their appetite for this. They're funding some of these deals now, as are other banks. It's taken the banks a little while to get their heads around this, who they would lend the money to, whether they're lending it to the company or to the trust, and how they would take security and various other aspects of how they can make that deal work. But there are now banks that will help fund an employee buyout. They've got their heads around it. So just imagine, on the strength of the profitability of SME Limited, just imagine the bank might be able to lend £2 million. Now, it would come at that from considering the cash flow of that business, the profitability, the underlying assets. But just imagine for this example that the bank is willing to lend. Now, it would typically lend to the trust or to a corporate trustee of that trust, and there might be good reasons why it would do that. But we have seen examples of where the bank has sought to lend to the underlying business entity itself. So there you go. We've got the ability to sell for 2 million now. Oliver and Ivor, however, don't think that's enough. So how else could we fund it? Well, just imagine there's some surplus cash in the business. As they've been building up towards an exit, it could be that there's cash in that business that's surplus to the operational needs, surplus to the normal working capital that was required. And that's not uncommon as the business is getting ready to be transferred, looking for a sale. Just imagine the profits are accumulating in the business. And in this example, just imagine there's 2 million, it's viewed as having £2 million of surplus cash in that business. Now, what would happen is that cash could be transferred to the trust. It's not usually a loan, it's a contribution to that trust. So suddenly now the trust has got the ability to get its hands on £4 million. And just imagine the trustees think, okay, well, maybe that's enough to tempt Oliver and Ivor to sell. Well, just imagine it's not. How else do we close that gap? Well, the normal way in which that's done is through what I'll describe here as vendor finance. So just imagine, as well as the surplus cash, the trustees, the employees, realize that actually out of future profits, we could afford to pay a little more. So just imagine the deal is struck and the deal is going to be done where the company SME Limited is bought for 8 million. We've got 2 million from the bank, 2 million of surplus cash, and then there might be this deferred money, this vendor finance, which means that over a period of time, we're going to see the 4 million paid down. So Oliver and Ivor are happy. They're happy on a deal for 8 million, and they're leaving in 4 million. What I mean by leaving in is they know that they're only going to get that out over time, over years, as the business performs. And that's the sort of deal structure that you might end up with. And the reason for that is there's only so far a bank will go in funding a deal. And typically they might be interested in looking up to 2.5 times EBITDA. There's probably going to be a limit on how much of the deal they're willing to fund. So it might be something like 30% of the enterprise value. They're going to get a return. They're going to want to get an interest rate on that. There's going to be an arrangement fee on that. They're going to want to do their financial due diligence and be confident that the valuation holds up. But they're not going to fund the whole deal. They're not doing the buyout. And they realise that there's going to have to be a gap that's closed. And to me, this is the absolute key in both employee buyouts and most management buyouts that we look at, is that the sellers have to be willing to take some of their money over a period of time after the deal. The old-fashioned days back in 2006 and 7, when a friendly Icelandic bank would come in and lend 7 times EBITDA to fund a deal, have long gone. That's not going to happen. The banks are going to look for the vendor to believe in the deal. If the vendor, the sellers, so Oliver and Ivor in my example, aren't willing to believe in the deal and be willing to wait for some of their money, if they don't believe it can succeed, why would the bank believe in it? So it's this blended approach, this balance of risk between what the vendors, the sellers, are willing to accept, that gives the bank confidence. Now that debt would be subordinated, so the bank's going to want to be first in line for getting repaid. But unless the sellers really believe in the deal and are willing to take some of the risk, it's not possible. It's not going to be possible to get a bank to the table. And then that also gives the employees confidence as well, because they're going to have a friendly lender in terms of the vendor who's going to have every interest in making sure that the business transfers and succeeds. And the other crucial bit in this, and this is the same whether it's an employee buyout or a management buyout, is in my experience, what's changed over the last decade or so is that if it's the seller who's going to be the key in closing the gap on the finance, then we're seeing most of these deals are initiated by the vendor. So there's quite a difference between the owners approaching the employees or approaching a management team with a structured deal saying, look, would you be interested in buying the company? This is how it could work. This is how it could be structured. This is how it can be financed. And the vendor has sort of packaged that deal and gone to the management team or the employees and, if you like, put it on a plate for them. And we see that as addressing some of the key soft issues that otherwise emerge. It's very difficult for the management team to knock on the door of the owners. Just picture the loyal, hardworking management team. They know they don't have enough money personally to buy it. They may not have the experience of pulling a deal together. If they go to private equity, then they know they're going to be diluted down. And you've got these challenges of, well, what happens if people say no? Are we all going to fall out because we can't do a deal? So in our experience, and most of the deals that we get involved with, it's this degree of vendor initiation, the sellers bringing the deal to the table when it's all structured and thought through. Now, there are some definite differences on funding an employee buyout and a management buyout. With the management buyout, there is a general expectation that the managers will put some money on the table, some skin in the game. And I think that makes a lot of sense because they're going to be taking on that responsibility and they've got to be committed to this. So during the hard times, you know that they've got skin in the game and they're going to stick by it and try and make it work. And there is a realization with employee buyouts that that's not going to be possible. And the banks also realize that you're not going to get personal guarantees from employees in the way that you do from a management team. So there are some definite differences there on how it's funded and what that means in terms of how the bank would support it and the risk profile that people would take. Does this mean the management buyout is dead? Absolutely not. There are very good reasons why an employee buyout may not be right, and a buyout that is focused on a handful of key individuals works. I mentioned that subtle difference between the service-led economy versus a product or manufacturing-led business. And I think that one of the keys to get your head around is whether the business itself, the goodwill, rests in the products or in the people. But also, I would encourage you to think whether there's a way in which a hybrid could work. So just imagine Ivor and Oliver decide that, well, maybe we need a combination of the two. Maybe we'd like the employees to have the majority stake because we believe in them, we think that's right, that fits with our beliefs. But actually, we know we've got to incentivize some key individuals. And it might be that they end up with a structure like this, where perhaps some of the business is held in an EOT. This is the one that benefits from all the tax incentives. But some of the shares are actually held by them still, or perhaps in an EBT, which has looser rules and is used for granting options to the key management or incentivizing new people to join them. And that might give them another mechanism to leave when they sell their final percentage of the shareholding, because they would be able to sell that. So in this case, Oliver and Ivor could sell their remaining 10% in a few years to the EBT, which then means the business is held 70% by all employees, 30% in trust, which could be used to incentivize and pass shares out directly to key management. And we're seeing quite a few structures where it's this combination of employee ownership, but with some key employees, key management people being incentivized via share options or via direct ownership at that point. And there are some other good reasons why you can incorporate some of the features of a management buyout when you're considering or if you're using the tools that are available to you through the employee ownership. And these are a little more technical. I won't go through them in all detail, but there is the ability to have some influence controls around how the trust is composed, how the board is composed, voting rights, dividend waivers. There are various ways in which you could structure this when you get into the detail. That means you can really incentivize the key management, but you can also benefit, and the employees can benefit from a broader employee buyout structure as well. So hopefully that was a whistle-stop tour through how buyouts are happening, what's changing in the marketplace. So it's more than just buyouts from management now. It's the use of employee ownership trusts to facilitate wider employee buyouts, and also some hybrid models which try and combine the benefits of both. So I'm more than happy now to take any questions that may exist. So let me just stop sharing my screen, and I'm more than happy to take any questions if people wish to pose any questions. You can feel free to either type them into the Q&A box, or happy to, Joe, if that's possible for, okay, got some questions firing in, so let me see if I can answer those. From Craig, how does an EOT exit? That's a brilliant question. A lot of the motives of going into employee ownership is to secure the long-term independence. So actually, one of the motivations for going in that direction is because the founders want to sell it to the employees. They want them to benefit, but they don't want the business to ultimately be sold on into a trade sale. In fact, I've seen one example where it was written into the trust deed that if the employee ownership trust did exit, then the proceeds would be given to charity. So you could form the trust with some long-term goals in mind. That said, I've also seen other options, and certainly the way the law is written, there is nothing to stop an EOT exiting. So there are some rules that if the exit took place in the first 12 months, that the tax breaks would be unwound. But an EOT could sell to trade. So Ivor and Oliver have sold the company. X years later, the employees or the trustees, in consultation with the employees, all realise that the long-term future of the business is best somewhere else, perhaps listed on the stock market, perhaps sold, or then the seller is the trust, and the proceeds would then be distributed, if you like, under the rules of that trust, this discretionary trust, but that would be for the benefit of all employees. So an EOT can exit. Some people desperately try to hard code it, so it's difficult for them to do so. Sam, hi Sam. How does a corporate governance typically work in an EOT? Okay, great question again. So the trust itself, so the trustees would have to operate under the rules of that trust. So you would have a trust deed, and that would dictate, if you like, certain governance issues. The trust would be, in examples I've given, would be the majority shareholder. So it would have some rights, but typically we would see in place there would also be a shareholders agreement. So the trust would also enter into an agreement perhaps with the other shareholders. So in the example I gave, the exiting founders, Oliver and Ivor, then there might be a shareholders agreement which would dictate how certain aspects of the business are run and controlled. There might also be some creditor agreements. So whilst money is still owed to Ivor and Oliver, there could be some agreements in place there which would dictate how things are run. But the crucial point is that a business is, the day-to-day running of the business is still determined by the directors. So the board, there's nothing to stop Oliver and Ivor being on that board. There would need to be, when we take a tax clearance on these sort of processes, and it is important to demonstrate that they're not still controlling the company. But the day-to-day decisions would be handled by that board. So the governance would have different steps to it, how the board operates, how the trust operates, and how the shareholders agree to operate between them. So those are the key documents. When that's been worked through in detail, usually what I've seen is that the sellers, usually Ivor and Oliver, are very keen, certainly if they're staying in for a bit or they're owed money for a bit, to make sure that the control and governance, if you like, has not, the whole thing doesn't become anarchy. Right, so another question here, how do employees contribute to the ownership? Through their salary. That is possible and has been used through some share ownership schemes where the individual employees hold the shares personally. In the model that I've just outlined using an EOT structure, it is the company profits that are actually funding the deal. So often we see that the employees do not have to actually put in money themselves to make this happen. Now, there are some hybrid models whereby you may wish to hold some shares and encourage employees to acquire additional shares over and above the ones that are held in trust. But actually, most of the EBOs that have happened in recent years, the employees themselves, if you like, are using their sweat equity. It's their hard work over the next few years and in the years leading up to it that have generated the cash or the future cash that's doing the deal. And in most cases that we see, the employees don't have to put their hands in their pockets. So for them, it's a no-brainer. That's a great deal. Another question, what are the benefits for the employees of having ownership in the business? Okay. I'm going to talk at two levels. One is financial and one is cultural. I'll start with financial, being an accountant. Once the profits are there, let's assume the business has been acquired by the trust and all the debt has been paid out, then that trust will be able to enjoy the benefits of those profits, and the trustees have the discretion to then incentivize or reward employees. Now, there are certain rules how that will be done, and people have to be treated fairly across all employees. So it's not cherry picking, it's all employees. But there is a tax-free bonus that I mentioned of 3,600 that means the individuals can get their bonus, or get a bonus depending on the success of the business. And I know that's quite an important driver in John Lewis. In fact, it was only this year, and it made the news. It was the first time that the owners of that, or the controllers of that decision-making process, decided because of COVID that the employees wouldn't be getting a bonus, and that was certainly news that it was widely on the BBC, etc. So there is a financial benefit. I think the other key benefit that I would touch upon are the softer issues, the cultural change, the alignment and the engagement, and the people that we work with who really decide that ultimately this is preferable to a management buyout for them. It's some of the drivers and the beliefs that they have around how the business should run and how all employees should be treated. And there is some of the thinking, and I guess this goes back to our own individual beliefs. There are some who are saying, particularly with millennials, who don't feel that it's difficult to be a lover of capitalism if you don't have any capital and you're struggling to get on the housing ladder. Some of the drivers behind this have been people who felt, well, actually, if they have a sense of ownership in the company, there is something intrinsically good and right about that will create loyalty. It will create that sense of engagement, and therefore one of the benefits of an employee-owned company is you will feel part of it. There's usually structures which enable employees to give feedback on how things are working. Often, going back to a governance point earlier, the employees may have a way in which they can vote for making sure that one of the trustees is representing them. So as the decision making isn't left to all employees, but you might have somebody who's particularly focused on them or representing them, either on the board or on the trust or both. So I think it's some of these softer issues that can also be important to be dealt with. I've got more questions coming in, so I'll quickly try and answer those. How can the owners maintain the majority for decision making? How can the owners maintain majority for decision making? Have 51% of the shares. What are the pros and cons of this from an employee perspective? Okay, so I hope I've understood this question correctly. If by the owners you mean Oliver and Ivor in the example I gave, they are not the owners at the end of this process. So the majority owner is the trust. So the pro and con, if you like, from their perspective is it is a buyout. The majority of control has passed to the EOT. If it wasn't the majority of voting shares that had passed, then you don't enjoy the tax benefits that I outlined. Those only apply, or certainly the selling parties only enjoy the tax-free proceeds if they're sold in the year that they're selling more than 50%, 51% of, to keep it simple. So from the decision making, ultimately, I mentioned shareholders agreements and trust deeds and things like that. But the decision making day to day is by the board. But ultimately, the controlling shareholder would be the employee ownership trust, and subject to those shareholder agreements and things like that, they would be able to use their voting rights as a shareholder to influence things. So it is absolutely a buyout. So I just want to make that clear. And from a pros and cons from an employee perspective, rather than the exiting owners, that employee can influence, I suppose, and I mentioned earlier, there's often mechanisms to enable people to feed into the decision-making process, the trustees, the board, and that is a key part in many of the deals that we see, a key part of that cultural change that people are trying to bring about. Okay, Joe asks, do all employees have to be included in an EOT, or can you select only certain employees? For example, a minimum term of service? It's a great question. And as a general rule, the employee ownership trust has to treat everybody equally. Now, that is not quite, that's not equally, doesn't mean the same. So for example, you could have bonuses paid out in the same proportion as salary. So everybody's being treated equally because you're saying the bonus this year is 5% of salary. Well, somebody who's on the bigger salary gets a bigger bonus, but everybody's been treated in that fair way. Interestingly, it is possible to have a minimum service term. Usually it's 12 months before people are beneficiaries of the trust. So there can be a hurdle, but then once people are over that hurdle, everybody's treated the same, and you can't cherry pick and leave some people out. Interestingly, the one example that you gave in your question, which was a minimum term of service, is the most common hurdle and was recognized when this was created, that you can have this hurdle because employees joining, let's say somebody joins and leaves all within 3 months, it's understood that may not be appropriate, that they're viewed as one of the owners in that sense. Also, Joe, our second question, can you also designate different percentages to different employees? Well, yes, just in the way that I outlined, if it's treating everybody in this with that equitable sort of backstop, that fairness that applies to all. So you're applying the same rules to everybody, then it is possible that you would get different benefits accruing. Those benefits, I guess the trust has got a couple of things to think about, as well as the benefits to employees. Obviously, in the example I gave, it still owes some money to Ivor and Oliver. So for the first few years, the trust is going to be concerned about paying off its debts. So there's usually a number of years before, all of the benefits are flowing out to the employees, because it's still got this debt to pay off. So when you talk about different percentages to different employees, just to try and answer that fully, in the first few years, Oliver and Ivor would probably still be employees, and they would be receiving some of the EOT, some cash from the EOT that's to do with paying off their debt, as well as, employees benefiting from distributions. Now, anybody who's receiving proceeds from the sale can't be a beneficiary of the EOT. So Oliver and Ivor can't have it both ways. They can't sell and be paid the proceeds from the EOT and also then be a beneficiary of that trust. And there's also rules around if anybody holds more than 5% of the shares personally, they couldn't be a beneficiary of that trust. So there are, to answer your question fully, Joe, it'll be quite technical, but ultimately when you work through all those combinations and permutations, employees that would fall into different buckets. Were they sellers? Do they hold some shares personally? Or are they really people who are represented by that trust? And if so, have they crossed that threshold of length of service? So hopefully that answers that question. Thank you all. Let me see if there's any other questions on there. Oh, there's one more. Thank you, Joe. And I'll try and answer this and keep on time. So, I think my apologies. I think I've answered that. So, couldn't tell. There's a question covered. A couple more. I'll see if I can answer this. Kuntel's asked, we currently have a share bonus scheme. Am I right in thinking that the final outcome for the employees is the same as what we could achieve with an EOT? You could achieve, as I say, you can achieve the benefits of aligning individuals with the goals and the success of the business through a bonus mechanism. Definitely, of course you can. They wouldn't enjoy the tax-free £3,600 that I alluded to, and they wouldn't necessarily then have representation on the trust, and there may be other issues. So you can definitely align the performance of the business with the rewards to the employees. The difference, I suppose, is that doesn't crystallize value. It's not a buyout of the owners. So you could achieve certain things. There would be different tax consequences, but ultimately, using a bonus scheme, ownership has not transferred. Lastly, one question on here, Andrew, not for the webinar, but is there a copy of this to show others? Jonathan, happily send you some slides. I'm going to hand back to Joe now. I believe this is recorded, so Joe, this might be available. You were saying on the website.
Indeed, and thanks very much, Andrew. Yeah, we've captured a recording of this, which obviously includes your slides as well as your presentation. So we'll make this an on-demand version on the website, and we'll also put it on our social media channels. So if you want to capture that, you're more than welcome. Just wanted to say thank you very much, Andrew. Thank you to the audience for your time and for all the questions. That's been great. And we look forward to our next webinar. Thank you.
Thanks all. Bye.